Strategic media and public relations is bringing together dynamic companies, investors, and consumers like no one before. And we're doing it in a unique way while addressing the big changes underway in our world. Our world is fraught with both peril and opportunity. The world is changing. Long-term conflicts are shaping up over commodities, currencies, and influence. Political lines are shifting. Yet mankind moves on to meet the needs of a growing world. Newer, cleaner energy, medical breakthroughs, ways to better our lives, better ways to move into the future. Join us now for today's topic.
Hello, and thank you for joining us today. My name is Eric Radez. I'm the president of Strategic NPR. I'm joined here today by the rest of my team, Chris Temple. He's our vice president. Chris, thanks for joining us.
Always glad to. We'll see what we can do today.
Awesome. Thank you for being here. And Konni's our communications liaison, Konni Harrison. Thank you for joining us today as well.
Thank you for having me. And just know, guys, if you have questions, don't hesitate to reach out and ask them.
No shortage of questions out there these days. You know, a lot of things going on this year. Obviously the election cycle's here. It's going to make things interesting without a doubt for the rest of the summer and going into the fall. We have different inflationary pressures to discuss. And, we just wanted to take some time today to kind of go over some things and try to bring things into perspective. A lot of things are changing, and over the past year we've had several different discussions about stagflation, inflation, all the moving parts of the economy, both here in North America and on a global scale. So what we wanted to get to today is to have kind of a less formal discussion and to kind of have a conversation with everybody. And our main idea here is just to get an idea across to you guys and to talk about what we see coming down the road. So, Chris, I'd like to turn it over to you and ask you, what do you think are the main points that people should be paying attention to right now in the markets and in the economy overall?
Well, Eric, I want to do a quick review of what we saw for the first half approximately of the year. We're slightly into the second half now. We're recording this on the 11th of July. But folks, for your information, we're going to be in some form, which is still in the works, actually launching a formal podcast by the end of the summer, early fall timeframe. This is kind of I don't want to say a trial run, because from time to time, Eric and Konni and I have done discussions and videos on different subjects, but I think it's good today for us to review the first half of the year, what was expected when we came into the year, what happened that we think should have happened, what didn't happen yet or didn't happen at all, and where we're at. I put out an issue, the National Investor, recently, and I had a special pullout of it that kind of recapped the first half of the year with some ideas as we go into the second half and beyond. If you're not already on my mailing list, make sure that you reach out to me at nationalinvestor.com. Just go to that website. And likewise, make sure that if you're not on Strategic NPR's mailing list, we have a lot of information here as well. Doesn't all overlap, so you really should be on both lists. So you want to go to strategicnpr.com and make sure you sign up for our list there. But guys, the kind of title that we have for this, and there's going to be another follow-up to this, is a roadmap, but for a road never traveled before. And I think that's a good segue into what we're challenged with today. Today, we're going to cover the first part of that, and that is none of us alive today, by and large, unless you lived as an adult through the 70s and early 80s. And even then, there's some differences today. We've got a situation where the world of disinflation and lower interest rates and so forth has left us. We're going to discuss as we go through this video right here, an audio presentation for those listening by audio, why we're going to see chronically higher inflation and interest rates going forward, and how that is going to upend a lot of investment strategies, a lot of suppositions people have made. What we're going to talk about in the second of these conversations and this is definitely a road that none of us have ever traveled, is the fact that none of us alive today, period, has ever lived through a world that did not revolve chiefly or primarily around the United States of America, our economy, our priorities, and so forth. But already for the last several years, and it's accelerating, we've seen a move away from globalization. We have trade wars flaring up. We have global wars, if you want to call them that, over commodities and currencies. And that is really going to upend things in the years ahead. It won't matter who gets elected president. It could be Trump or Biden or a gerbil that gets elected as president this year. These things are already set, and they're evolving, and we need to understand those as well. So let's get with it.
What promises were we told back in the fourth quarter of 2023?
Well, promises meaning what we're going to see this year?
Yes, sir.
Well, I think the biggest one that should have upended the financial markets and never really did, obviously, to a great extent, when we see the S&P 500 and the NASDAQ hitting records almost daily in the recent past. The Dow hit a record several weeks back. It's kind of underperformed the others recently, as have the small caps still, which has been a chronic story for the last couple of years. But we ended 2023 with all of a sudden Fed Chairman Jerome Powell deciding he was going to be Scrooge on Christmas morning, and it surprised markets at the time when he kind of flagged the pivot he saw coming. And that was because inflation rates had trended down for the last few months of 2023. And so he was suggesting that we were going to start seeing rate cuts pretty quick. And so the markets cheered that, and of course started out with a rally. December of last year, there was the expectation in the markets that there would be 6 or 7 25 basis point rate cuts in 2024, or the equivalent thereof, if they wanted to do it in bigger chunks. The most recent Fed meeting, a couple of weeks ago, they were saying that now they see 1 rate cut for the balance of 2024. We haven't had any yet, of course, we know that. And with some chatter recently that they may not do it at all, or if inflation turns back up, they may not be done raising interest rates yet. Now, you would have thought, and a lot of people did, myself included, that with that change in the Fed's expectations or promises, if you will, of how many times they're going to ease policy this year, that the markets would have sold off. Yet again, they didn't. You've had, and it's been very top heavy, the market, as a lot of people have heard, the Magnificent Seven stocks, the big cap tech, the AI darlings and whatnot, have been taking all the oxygen out of the room. If you look at the broad market has been meandering kind of sideways by and large. But the big stocks and the big indices continue to set records because everybody, despite this change in when the Fed is going to start easing, is still all trying to front run that, and still all of a mind that they want to, make sure that they place their bets before we have a new easing cycle, which we're not going to get. Okay. And I'll explain that a little bit later as we go along. But, so it's been strange. And even with the Fed not cutting rates yet, we have still seen other areas set records as well. Didn't help gold stocks at all as a group, but gold has hit a new record numerous times this year as well. As we're recording this, it's back over $2,400. It's been kind of topping in that area for, on and off for some months now. Copper a while back hit a new all-time nominal high, well over $5 a pound. It's tailed off a little bit recently. So it's been interesting that we've seen these kind of behaviors, even though the Fed has not yet started cutting rates. There's a lot of reasons for that.
I think silver has probably have been the top increase as far as the commodities this year. Silver has outpaced everything, and not too many people are even talking about that. So, it's
well, yeah, in percentage terms, yeah, silver has done a bit better. Silver is nowhere near its all-time high. I mean, the silver twice in our lifetimes was $50 an ounce. It's a little over 30 right now, But having underperformed gold for so long in relative terms, yeah, silver has done well, and it's I think it's 13 or 14 years since silver was up where it is right now.
Yeah, and I guess it's all a supply issue, and as you've said before, supply is what's going to be driving this year, and that surely made itself evident in the commodities market so far.
Well, it's made it self-evident across the board, and I would encourage folks again who are watching, if they never saw this, to make sure that they reach out to me and get my commentary as we came into this year, because I said that if you want to understand markets in 2024, you need to understand three words: supply, supply, and supply. And like you reminded us, Eric, that's been absolutely true. And I'll take just a second to hit on a couple of those things we didn't already mention. The big one being that for all of the talk of the Fed tightening and indeed raising short-term interest rates by 525 basis points from start to apparent finish right now, because the odds are that the next one will be a cut sometime late this year. Despite those rate cuts, you need to keep something in mind, and that is starting in the fall of 2019, months before we heard about COVID, and then big time with COVID as the backdrop and the excuse, the Federal Reserve went on a money printing binge unlike anything seen in the annals of history. 30% of all the dollars ever created in the history of the US of A came out in a little over 2 years' time, which is why you've still got such liquidity in the markets. Whether the prices are realistic or not doesn't really matter. You've got all that liquidity out there, and it's got to go someplace. But if you look at a chart of the broad money supply, which is called M2, all right, this is one of the broad measures that the Fed uses. I won't get into the whole formula and the reasons for it. We were already for many years on a fairly steady upward trajectory because of ongoing monetary inflation, because of the size of the debt and so forth. M2 went parabolic over COVID. And for a little while, it started to come back down. It recently has gone back up in the last several months. But the bottom line is that the level of M2 now, this is the overall liquidity, the overall money supply, is still well above the already upward trending trend line that we had for years. So yes, the price of money, the price of credit is considerably higher than we got spoiled with for years, especially if you're an institution and we're borrowing money, for 0 or 0.5% or 1%. Okay. But there's lots of it out there. And this all will still come home to roost at some point. There's a lot of stuff out there that's still going to hit the fan at some point in time, as I showed in my mid-year issue. But that liquidity is still there. So that's the big thing about supply. And going forward, that supply issue, I think, is going to continue to be something that keeps upward pressure long term on most commodities, because after years of underinvestment, there's too little supply of commodities when you look forward in time based on what we're going to need for infrastructure, for energy, for the energy transition, whatever you want to call it. And the big one being debt and interest rates. There is such a burgeoning supply of new debt that perpetually comes out, only gets worse, that we're going to see chronically high interest rates, not because the economy is doing great, not because the economy is doing bad or anything like that. It's going to be less about the economy and more about the sheer volume of debt that needs to be issued and rolled over. So yeah, the supply word is something that we're still going to be talking about for some time to come.
So with all of these things happening, and back in the day, you compiled your information and made decisions. To your point about the broader markets and their performance, why doesn't the stock market, even with the specialty stocks, if you will, reflect what's going on in the macro economy. Now, for today's purposes, it's here in the US, and we'll get into the global later, but what's going on that's making people and institutions flood into the stock market when everything around is got that red light siren happening, and to be cautious?
Well, Connie, there have been noteworthy times in history where and people hear these cliches, whether it's chasing the masses, FOMO, fear of missing out, everybody chasing momentum. One of the biggest misnomers that people need to understand, and we all know this because all of us in one way or another have been in the retail financial planning and investment industry before. I hate to burst your bubble, folks, but as a general rule, and of course there's exceptions to every general rule, but as a general rule, your financial advisor or broker knows no more about the markets than you do. Some of them know less. They're great at helping you fill out paperwork and telling you where to sign and how to make out the check. Okay. But they don't have any idea any more than the average citizen does what makes all of this tick. They are paid and they get business to a great extent based on performance. And it doesn't matter how stupid it is. It doesn't matter how nosebleed high small groups of stocks get. Performance tends to chase itself, and people are if you want to be chronically a bear, let's say, and say, oh, I think this is ridiculous. I mean, I won't mention names, but a lot of us have run across people for years who have chronically bearish. We call them perma bears. And since the Dow was 1,000, they were saying it's all going to crash. We're going to have an epic deflation, et cetera, et cetera, et cetera. Those people are wrong long enough, and who wants to do business with them? Who the hell wants to give them their money or buy their newsletter or whatever? You want to chase what works. And if you're a broker, there's pressure on you. If you don't outperform your peers, and if you don't keep up with the indexes, you're going to be fired. People are going to go someplace else. All right. Now, these things eventually revert to the mean, sometimes very dramatically and abruptly. But for a while, and we're in that period of time right now, you have a mania that's part excitement over something new. And not to dismiss artificial intelligence, that's a big driver of some of this top heavy performance recently. You've got a lot of foreign money coming into US stocks and US dollar assets because the US stock market has been outperforming most of the rest of the world. The US dollar, compared to its major peers, has been stronger for the last couple of years or so than the rest. And so the whole world is putting their money here. And the question is, when does it end? Now, historically, there have only been two other times when the top 10% of stocks by performance commanded as much of the overall market capitalization, the value of the entire stock market, as we see right now. You know what those other two times were? I'll give you three guesses. The first two don't count.
.com, baby, .com.
That's one of them.
Great Depression.
That's one guess?
And that was the other one, Eric. So in 1929 and in 1998 and 99 were the only two other times in history where the top 10% of public companies by performance commanded as much of the overall market cap, leaving the rest behind. All right. We know how the first two ended. This one will end maybe not as abruptly. I think it's going to be a slower process because there is so much liquidity out there, but the economic reality will set in and this will right itself once more. The trouble right now is that there's still so much liquidity out there. There's a famous saying that the market can stay irrational longer than short sellers can stay solvent. So it's been a fool's errand. And I can tell you once in a while, I've been a fool. And even with the small part of our recommended portfolios, I say, okay, we need to hedge a little bit here. Let's buy these inverse funds that bet against the S&P or well, that's been a lost cause recently. Okay. It's been good to short individual stocks, especially the most vulnerable areas, which is a story I'm talking about in my newsletter right now. But otherwise, this thing can stay silly. you know, in 1999, at least we knew that there was going to be pretty much a date certain by which the mania was going to end, and that was January 1st, 2000. Well, what was relevant about that?
Well, that was the Y2K scare.
Right. That's right. So when January 1st, 2000 came, we were all still here. Airplanes weren't falling from the sky. You still had your bank account you could access and so forth. But there were enough worries leading up to that that the whole world, to some extent, decided that they wanted to pile into US stocks. And especially if you're a foreign investor, do you want to pick individual value stocks or individual commodity? No, you want to chase what everybody else is chasing. To park your money in the biggest cap, quote, safest type of stocks. And so that's why in 98 and 99, you had such a top heavy performance too. If you were in a general mutual fund in 98, 99, your performance stunk compared to the .com stocks and things like that. But at least we knew that when that mania ended, when Y2K proved, generally speaking, to be much ado about nothing. All right, well, the emergency or quasi-emergency or, thought of emergency or whatever is over. Now we can start pulling our money out. So that was the only time, I guess you can say, where somebody did ring a bell at the top. What's going to change it now? I have no idea. There's always a black swan event lurking out there someplace. The big one, which here again, if we were looking at this at the end of last year, we would have said that commercial real estate is going to, knock the market down in the economy and banking system a couple of pegs in 2024. What failures there have been and what cracks there have been have been sloughed right off like water off a duck's back, at least so far. Here again, that may not stay that way forever, but right now, it's lots of liquidity, and for the big cap names, it's been party on.
And so I guess the stock market is really at this point trying to price in still a couple of rate cuts this year, possibly. I mean, we just saw a new high in the S&P yesterday, as we stated earlier. And it's quite possible that those cuts may not take place this fall, but the market's still pricing it in. So, how does the Fed stick a soft landing if indeed there is not a rate cut to be had yet in 2024? I mean, what are the ramifications of that?
Well, here again, Eric, that's a good question. I'll try and boil it down or distill it as best as I can. We've got to look at two different entities. We've got to look at Main Street and Wall Street. Main Street is already in recession. The jobs numbers have been worsening somewhat, but even that, where 4.1% unemployment rate, which we're up to now, is still relatively low by historical standards. But that's a lot of government and temporary work. It really doesn't reflect the true state of things. A lot of people believe, myself among them. When you look at most of the consumer confidence numbers recently, as well as the expectations for future inflation, which have been rising still recently, even as the headline numbers tick back down slowly. The Main Street economy is still in some trouble. You look at retailers, they're starting to gasp for breath. Look at Nike, look at the basket case of a Walgreens recently. Even the bigger representative names like a UPS, like a FedEx, like a Costco, like a Walmart, they've been saying for the last few quarters that they're seeing people sit on their hands a little bit more. People that come to the store, the overall bill is going down as far as what they spend per trip. They're spending more on private label things. So Main Street is in more distress than I think the Fed wants to acknowledge, and certainly than the politicians led by the present administration want to admit. Yet against that, we've got this false sense of security with the stock market still doing well, and with the GDP numbers, which are skewed by financial activity, still not going into negative territory yet. But keep in mind, And it doesn't matter, and we're going to get into this, as far as how this is going to evolve depending on who wins the election. Look, high inflation is baked into the cake for a variety of reasons, not the least of which that the Fed has, printed all this money and has taken precious little of it back when you get right down to it. So it's still all out there. It's still all pushing up prices of various things. Will some disinflation emerge? Sure. As the economy gets worse, people are going to spend less money still. But unfortunately, the stuff that we can't do without, food and fuel and electricity and insurance and housing costs, all those things, they sure as hell aren't going down. And I don't think they're going to. There's a lot of reasons why they won't.
Yeah, and I just saw that on the news this morning. I think for the first time, I can't remember how many years, but Costco is going to raise their membership fee.
I saw that too.
And the big thing they were talking about is, are they going to raise the price of the $1.50 hot dog package, and everybody is like freaking out about that. So goodness gracious, if Costco's raising the price.
I just had, every 6 months car insurance rolls over, right? With a lot of people, and that's what just happened to mine. I have a really good company here in Florida that I'm happy with. They've done well by me in the past. Can't kick a bit. It's the Florida Farm Bureau. I just went from $156 a month to $212.
Wow.
And I called the guy up, what the hell happened? I didn't have a claim. What's the deal here? And he says, this is across the board. If you don't believe me, go check with others. And it's really true. And I said, I try to dig into it more. Well, why such a big jump all in one fell swoop? And he said, what's gone on in the industry is that what's catching up are labor and parts and so forth. And again, these things aren't going down. So when you have a car repair bill, the cost of labor, the cost of parts, all these kind of things, these are going up way faster than this 3% and 3.2 or 4, whatever inflation that we're quote down to by the official numbers. So this stuff is not going away. And I think, Eric, the expectation I think Wall Street has that is the least correct and is going to be the most troublesome once reality sets in. And it's going to be a process. This may still take a while. There's this idea that we're going to have a binary outcome of some kind. So the thought is, and all of these people tripping over one another to buy these already overly expensive Magnificent Seven stocks and others have got it in their head. Not that the Fed is going to start lowering rates, but that when they do, it's going to be the start of a full-fledged rate cutting cycle that's going to go on for a while. That's going to take us right back down to puny levels of interest rates. And that ain't happening, period. And that's going to be the big light bulb at some point, probably not till next year in a big way, that goes off over the heads of the markets. The Fed is already trying to sell this idea. And folks, write this down, or if you're driving, remember it, whatever. Okay. The Fed, from time to time over the years, has made a fool of itself by some catchphrase or some word, and they end up later on with egg on their face. Okay. Transitory is the big one. In the last few years, we were all told inflation was transitory. That obviously wasn't true. But the one that they're trying to sell now, the new phrase, is mid-cycle course correction. And the European Central Bank has already started this. The European Central Bank recently cut short-term interest rates there by 25 basis points. But now half of the people that voted for that cut regret it. And they're warning that we may not get another one for a little while. And this is with the European economy in way worse shape than the US economy is. But even there, inflation has stayed sticky. It just doesn't want to come down. And Fed Chairman Powell and some of the other Fed heads have already warned us that they might, yes, they at some point will tweak things. They'll course correct. If inflation continues to be a little bit better behaved, it's still not anywhere near their supposed target. But, we've gone from 9 or 10% down a little over 3 by the official numbers. And if we hang around in there, okay, fine. we don't need to be 5.25% anymore. We'll cut 25 or 50 basis points and then sit and see what happens. Nobody's expecting that. Nobody has priced in their portfolios for that. They all think there's going to be this aggressive rate cutting cycle. And short of a major cataclysm like a 2008, that's not happening. And so that's what is going to, over time become a bigger reality check to markets and the prices of all asset classes is if inflation stays chronically high, if interest rates only get cut a little bit and stay there for quite a while, let alone have to go back up if they miscalculate and inflation perks up again, then all of these bets we've seen the first half of 2024, certainly for the big cap stocks, they're not going to look so good.
So what I'm hearing is the math doesn't give us a quick fix by any stretch of the imagination. When you factor in all the numbers, all the math, if you want to take it from just that factual angle, it doesn't work. There's not going to be a quick fix. Is that what I'm hearing as well?
We're going to have a slow, dull ache going forward. The economy is, and as I mentioned a minute ago, Connie, Main Street is already feeling recession. The average household has already been tightening its belt. You've seen it in restaurant sales. You've seen it even though we have nominal increases year over year in energy consumption. There's a lot of people pulling their horns in, even with this summer travel season. It's not been as robust a demand situation for gasoline as a lot of people thought it would be. Now, look, I'm still bullish on old energy going forward. That was one of a few special issues I also put out recently, folks, that if you drop me a note, I'll send it to you if you're not already on my email list. But I think by and large, we're seeing things start to bog down a little bit. And again, because there is still so much liquidity out there, I don't think we're going to see anything necessarily collapse. But another thing we're going to start to learn in the coming months and quarters, Connie, is that there's a difference between liquidity and solvency. There's a lot of insolvency starting to rear its head. If you look at credit card delinquencies, if you look at the delinquencies on subprime auto loans, they're at their highest, both of them, in a lot of years and going higher. So there is some stress out there from the fact, it's a lot of people remember that little kid story, the little engine that could. Well, the economy is the big engine that could, and it could only do what it could do with lots and lots and lots of cheap credit for so long. And that's all dissipated. All of the free money the government gave out and added to the debt because of COVID, that's gone. A lot of the one-off things that kept the economy and economic activity and the markets afloat, those have all dissipated. And so going forward, we're at a place where consumers and businesses both have much higher debts than they did, higher living costs, tougher decisions to make about what they can spend and what's got to slide this month. And that's not the stuff of a robust economy going forward. It is the stuff of increasing still credit card and auto loan and eventually some mortgage delinquencies, more so business. Another thing that Wall Street simply is not priced in going forward is for what happens if inflation and interest rates stay near their current levels, going forward. And we're going to live with this again for a while. We're back at much more of a normal world than the artificial world the Fed gave us through what was called financial repression for so long, keeping rates forcibly lower than they should have been. Those chickens are coming home to roost. On that subject, I think it was James Grant, one of the venerable analysts out there, had for years of Grant's interest rate observer. And I'm paraphrasing something he said several months ago, but he said, I'm less worried about interest rates now at 5% and what that's going to do than I am about all of the bad decisions and malinvestment over the so many years of interest rates at 0%. and how we have yet to live through the consequences of all that. And we're going to start to live through them. Again, as I said a few minutes ago, it's starting out with, a bank failure here and there over commercial real estate. And this is interesting, folks. There was a story I read not that many months back in Los Angeles. A big commercial property sold for $153 million or something like that, which was $115 million less than it's changed hands for the previous time there was a sale. That's a huge drop. 20% or something like that of all of the office buildings in this country in major cities, most of them on both coasts are like the industrial heartland, Chicago, and those areas, they're vacant. Okay, and a lot of that has happened in the recent past. A lot of it is because of lifestyle changes and COVID, and people realize they can work from home. A lot of it is other reasons why there's less demand for this. But the problem with all of those vacancies is that the lenders, the creditors didn't say out of the kindness of our hearts, we're going to knock your loan balance down by 20% too. They didn't do that. It's still there. But now you got a whole lot less rent coming in to service it. And that's something that we've seen, a few problems with some, bank failures, these regional banks. Last spring there were several of them. Early this year was a couple, but we haven't reached critical mass in that yet. And it's an open question how much that's going to take a chunk out of the broader market if we start to see these problems accelerate.
Mm-hmm. Well, I guess now, guys, we need to dip our toe into the hot pool of inflation and the political ramifications slash propaganda we're hearing out there and all of everything that comes along with it, right? We have to talk about it for just a little bit. So, on one hand, we're being told that, that Biden is the one that got us to where we are now in our inflationary situation. And then we're hearing from the other side, well, if Trump takes the White House back again, it's going to be even this what they call it, Trumpflation and tariffs, and it's going to make it, everybody have to pay more for stuff we're getting from overseas, yada yada yada. So I guess the question is, does it really matter which one of them gets in the White House when it comes to inflation, or is it really come down to Powell and what the Fed's got going on? So what do you think on that, Chris? What do you think about that?
Yeah, you largely answered your own question because, as the late Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon. And as a first matter, when the Federal Reserve prints way more money in credit than what the economy can absorb, prices go up. And it doesn't mean that everything is that much more expensive. It means that there's too many dollars chasing relatively fewer goods and real estate and stocks and et cetera. So that's the first point I want to make, and I think a great lesson from history, to be fair. And look, I do my best not to be partisan. I call balls and strikes on issues. I look at facts. I look at things on the ground. If something is, if Biden or the Orange Wonder are to be praised on something, I'll praise them, and vice versa. Historically, the worst bum rap of any president in my lifetime was the one that Jimmy Carter has lived with, where he was supposedly presided over stagflation and malaise and high living costs. He had nothing to do with those things being unleashed. That came before he was ever in the White House, thanks to Richard Nixon taking us off the gold standard, and thanks to Nixon's Fed chairman, Arthur Burns, who made things worse by all of the money he printed and keeping the dollar too low for too long. By the time Carter was in there, we already had this well entrenched to the point where Nixon had to impose wage and price controls at one point to try and knock inflation back down, which failed. And then later on, Jerry Ford, those of you who are old enough remember the WIN buttons that we had, WIN standing for whip inflation now. So Carter was the one that had to come in, and eventually when he appointed Paul Volcker, at least temporarily, cleaned all of that up. He got the blame for it because he happened to be in office. All right. Now that said, if Donald Trump when he was president, had his way over hectoring the Federal Reserve to keep interest rates low, even take them negative, which he suggested doing at one time, we would have had higher inflation had Trump, let's say Trump had been reelected in 2021 or 2020. We would have had higher inflation because all else being equal, the Fed would not have responded if they'd listened to him, and we would have had a cheaper dollar and higher living costs. As it is, since Biden has been in the White House, not that he had anything to do with it either, Jerome Powell did belatedly, and after first causing the problem, start raising interest rates a lot. Now, can presidents affect the inflation picture beyond that base? Yes, they can. In Biden's case, the biggest mistake he has made, in my view, is that he has not allowed his own signature policy of the green transition to be met by the supplies of nickel and copper and lithium and other things that we need in this country in order to make electric vehicles cheaper going forward. So when you hamstring the development of resources that we need, what does that mean? That means that within our own four walls, the prices go higher than they should have. Okay. Now, and I don't see Biden changing that very much. Very, very, very slowly has some of the people in his administration and the Energy Department, especially the Defense Department, come out and realized, okay, we got to get serious about funding some of these critical metals and minerals and so forth so that we aren't dependent on China, et cetera. But aside from that, Biden's only response of meaning, and it's the wrong one lately, has been to slap 100% tariffs on imported Chinese electric vehicles, slap tariffs of various magnitudes on solar panels and solar panel parts and stuff like that. And of course, tariffs in the end are a tax on consumers as well, which he himself said when he criticized Donald Trump for that when Trump was president. Now he's doubled down on a policy he criticized Trump for. Now, I believe, and this is a story probably more so for another day, if this actually does come about, we'll definitely be talking about it. But if Donald Trump is elected / reelected this year, I think we will see nominally higher inflation going forward, but we will at least get some kind of economic growth with it, because he would make sure that at a faster pace, manufacturing, mining, and things like that come back in a more robust fashion in the US than what we've seen. At the same time, he has promised that he's going to rely on tariffs to even a greater extent. And we're not going to get into this today, folks, but if you really want to roll up your sleeves and understand what Donald Trump is all about and how this would impact inflation, go to Wikipedia, go to your Encyclopedia Britannica if you still have it on the shelf, go to Google and look up the word mercantilist, because that is what Donald Trump is. Those are the policies he started to pursue in his first presidency, and they are the ones he would more aggressively pursue if he gets back in there. Mercantilism is not protectionism. It's a much broader menu of economic and trade priorities, and they will give us over time a cheaper dollar, higher commodity prices, but probably higher stock prices, especially those stocks that are tied to commodities. So that probably didn't answer for the whole purpose of your question, Eric. But we're it's like I said actually in a thing that I put out. People that think that either Trump or Biden is going to be good for inflation. I said, all right, well, you want to die by firing squad or by lethal injection? Those are kind of going to be your choices.
Before we roll, I do have a funny story.
Sure.
A friend of mine, I saw was wearing a Trump baseball cap from 4 years ago or whatever it was. And I laughed and I said, you may want to be careful wearing that in the great state of New York, depending on the area that you're in. And he laughed and he goes, you want to know the real kicker? And I said, what? So he takes it off. He looks at the tag and he goes, guess what this says? And I said, what? And he said, made in China. And I said, oh, God, it doesn't, but it just, completely contradicts what he says. And, government's tough. There's no way around it. But, we got to live with it or move. So those are our options.
Yeah, well, speaking of China, when we do the second of these coming up soon, folks, when the three of us can get together and do it in the coming couple of weeks or whatever, the roadmap that we've never traveled before, as I said at the outset, is this reversal of globalization, a lot more sectarianism in the world, economically speaking. That is, globalization, internationalism is being replaced by nationalism, by friend sourcing, by onshoring of industries that we long since got rid of. And there's going to be a lot of ramifications of that. And of course, when we get to that, we're going to be talking a great deal about China, because China is going to, China right now, and, down here in Florida, we got just a little bit of an impact from Hurricane Beryl that just hit, parts of northern South America, the Yucatan, Mexico, Texas. And then even up where you're at, Konni, I understand up in the Northeast and even parts of Canada, lots of torrential rain and stuff. So this thing had a lot of moisture with it that it dragged all the way up through, the US and into Canada. We didn't get that much here. And one of the reasons being is that there was this blocking mechanism one of the meteorologists talked about over Florida that made sure that this thing was steered well to our south and then to our west. In a similar fashion, and this is a story that I'm really rolling up my sleeves and looking at, China has already started down the road of what's called Japanification. What do I mean by that? You had a lost 30 years in Japan of essentially no economic growth, no inflation, stagnant incomes, and all the rest. After Japan had major bubbles burst, its stock market in 1989, its real estate market just after. It was only in the last year, since 1989, it was only in the last year that the Nikkei index in Japan matched where it crashed from in 1989, a long time. Japan has started down that road because of enormous debt levels, enormous overcapacity. One of the reasons they're selling electric vehicles for $10,000 to $20,000 when the cheapest, Tesla, for example, in the US, I think these days is around 30 or so, is because China, first of all, they have a lot of cheap raw materials, which we don't. That's a big problem for the US, and we're going to talk about that again in our next video. But they've got incredible overcapacity. So what does this mean for China? Unlike the challenge that the US faces right now, China has quite the opposite of a chronic inflation problem. They're desperately trying to fight off deflation, which will destroy their country and cause a major economic and banking crisis worse than the few hiccups they've seen in the last few years. They have incredible overcapacity there. Because of that, and this is a real weird thing recently, there have been stories about how the US Treasury and some of its auctions recently has had trouble, and they've had to bump up the interest rate, with 10-year interest rate being 4.3 or 4.4%. You know what the 10-year government bond is? You know what it's yielding in China? Either one of you want to guess?
I have no idea.
0.42.
2.1.
Oh, 2.
And people are fighting over it. Wow. Right? How did that happen? It happened because the people that are buying 2.1 or 2.2% paper for 10 years in China are willing to do that because they see the next 10 years being deflation in China and being an economic contraction in China. That will have some reverberations throughout the world. It might temper somewhat the inflation that we see in the US, but there will be a hell of a price for us to pay for that. And that's one of the things we're going to talk about next time, folks.
If you haven't subscribed to our channel, make sure you click that button down there. And we'd love a like too. If you could give us one of those, we'd appreciate it as well. So thanks for joining the SMPR team today. And we look forward to seeing you guys in the near future. Have a great day now.
We hope you got a lot out of today's subject. Make sure you avail yourself of the resources and contacts offered today. Subscribe to this channel for future topics and opportunities. And if you have any questions, drop us a line. Thanks for tuning in.